Okay, so got to introduce Chaz from my program in the process of graduating. Came in with a bunch of ideas. I'm not even trying to attempt to describe them right now. I'm going to let him tell us about his thought process, what he came up with, and so we're back. We're back on the spaceship and taking off. I don't know where. Let's see where Chaz is taking us. Charles Dodson. Go ahead, John.
Nothing too crazy. All right, can
Okay.
everyone see it?
I don't know. Wave modeling. This is
Okay, good. All right, cool. So you guys can see it though. Okay.
yeah.
So essentially, I came in with this harebrained idea. I didn't know if it would work, and I proposed it, and everyone said, "Let's go ahead and do it." So this is a quick timeline. If I were to think of, there were three main parts of this capstone, really almost at thesis level. There was this formulation stage, which we'll get into, which was longer. And then really what I've accomplished is the applied research slash learning, self-education. And then whoever wants to take it on or, take it to the next steps or help me do it because I'm going to do it. In the following year to a few months, I'd be more than happy to keep the project on the program, but that is really where we are now, right in between these two steps, somewhere. I don't know where, but we're somewhere in between this. Okay, so what this was really me having the harebrained scheme to model asset prices as wave functions. Again, I had no idea what I was getting myself into with that idea. And then with the help of some advisors, some other classmates, there was some direction given. And I had to read a bunch of research papers, upwards of, I think, past 35. If I go check the file of how many research papers I've saved in total, around 10 of them were used to get this going. And then really, when we moved along, there was an aha moment. So this is from one of the papers to do with the LPPLS model, to where when I kept reading along all of these research papers, right? These were the main research ideas that I deal with: the Hurst exponent, mean reversion trading strategies, the LPPLS model, clustering algorithms, and OU processes. There was no clear agenda on making a better quantitative actual trading strategy, right? Because the way I view it is there are strategies, there are models, and then a strategy is a bunch of models made up of other models. So with that being said, is most of these research papers, you take one looking at the Hurst exponent. Well, the Hurst exponent will say, okay, we're going to select XYZ using the Hurst exponent. Okay, that's great. But then their trading strategy is, let's throw it at a few Bollinger Bands and see what happens, right? Well, it's not the best trading strategy, right? I think we can all agree that there are probably better methods to do that. So essentially what happened was I saw this graph and I said, quantile regression, that sounds interesting. And essentially, sorry, I couldn't make my own visual, but if you can look at the peaks of all these quantile regressions, you can make a confidence zone. Now, with that confidence zone, we aren't necessarily doing market timing or trying to say, we're trying to do a confidence zone for direction and for time. That is the main goal of where I want this to go. So if you can try and visualize drawing the peaks from here, drawing it, and essentially with all these peaks, you could draw a zone, right? And in this zone, to where essentially it would become, if this spread, right, picture of a spread, a mean reverting spread on a pairs trading idea isn't going to look like this, right? It's not going to be trending. Hopefully, it'll be flat with oscillations. So essentially, what I want to happen is we take a quantile regression. There would be a zone to then go into, to where if we enter that zone, we either enter a sell or a buy. Now, getting into that later, we'll go along that as we move forward. So And that was the main idea. That's the end goal, right? And the end goal with that is to show that because the LPPLS model is technically modeling waves, we could say, oh, look, now there is wave-like nature in asset prices, and my idea is somewhat correct. Now, granted, you need to do a bunch of finicking around to get it to show that there's wave-like nature, but we could say that there's wave-like nature. So now I needed to answer some questions. What to trade and how to trade. So the what to trade part is probably the tougher question, right? That's the tougher question that I think everyone always thinks of is what am I going to buy? What am I going to go short on? And then the how to trade is the easiest part, right? Because what this really became was me understanding, one, if say I'm working under a PM or I am a PM, I need to be able to understand what can I trade and how am I going to trade that, right? Because if you could think, as if you try and put your PM hat on, you're thinking, okay, well, a bunch of our strategies put on a lot of risk and a lot of leverage. They're not doing great right now, so we need to put something on that doesn't have a lot of risk but can generate some return. So that was kind of the hat that I put on. Well, that's an easy one. And with the end goal of the model, we need to look at mean reversion, right? Because if you look at a mean reversion graph, you can say that there's wave-like nature to it. So mean reversion, pairs trading. That was the quick and easy answer. That was the easiest one that was the easy question to answer. So a quick back story or explanation of what pairs trading is. I'm going to do it for a 5-year-old. You have these two lines right here, right? They look like they move together. And if we can look in these two boxes, it looks like for a little bit, they don't move like they're moving together. That was a long sentence, but you understand what I'm saying, right? So essentially, if we look here in the first box, there are probably a few points to where these lines don't move together. Now, when these lines don't move together, there's a way to trade it so that you can capitalize on the deviation of the long-term spread or the long-term co-movement, okay? So that is essentially what we're trying to do. Now, there's I guess you could say the entire problem within itself is how to choose this, right? Because you could say, okay, Apple stock B and Apple stock C, right? Well, I've looked at that and it doesn't work, right? Because you're only going to be collecting a few cents here and there. You could say, I don't know, a high yield ETF against a long-term high yield ETF. Well, that might not work either, right? So we need a quantitative way with research behind it to show that we're picking the correct pairs to trade against. So
one thing, Charles, one thing.
yeah.
So you're not mentioning correlation, but you're mentioning mean reversion here.
Correct. Let me keep going.
Okay.
All right. So, and then essentially what I thought of was, okay, well, we need a way to say, however you want to rebalance your trading strategy, your portfolio, whatever it may be, right? We need a filtration algorithm, right? And this is just a hard stop at, these are the pairs we're trading, and this is why, right? So essentially with this algorithm, we have a pretty strong way to say that these two pairs are tightly co-integrated and also are mean reverting, right? Because you need the spread to be mean reverting because they need to kind of oscillate for you to make money. You may want something that is, if you're talking about pure mathematics, you may say, oh, well, we want the tightest co-integrated pair. Well, not necessarily, right? Because if they don't deviate, then you're not going to make any money, right? Because you're never going to be able to trade them. So you want something that is co-integrated and not necessarily too tightly to where they're essentially the spread never moves. Now, a quick point to that is co-integration is different from correlation, where correlation looks at short-term linear processes, and co-integration is looking at the co-movement based on a certain confidence level. Now, let's talk about the actual filtration algorithm. So we take our price data, we do a PCA reduction. Now, all that is essentially, well, a PCA reduction just collapses a certain matrix of data into where we're not losing a certain amount of variance, right? Most people say 80%, some people may even say 70%, but essentially we want to keep the same amount of variance, but shrink it down dimensionally. And then from there, and there are a few ways to do that too. I've done it in this back test. I did it a bunch of different ways. You can use the Kaiser method, which isn't too complicated. You can, essentially throw a covariance matrix at it to where you can say, okay, this is how much variance is explained based on these many factors. And you can set your however much you want, right? Because you could have, how much then you get a vector of how much is explained based on the variance, and then you basically say, okay, well, I want 90%, I want 85.27%, right? Whatever you want it to be. Now, if you're just jumping into this, probably do the Kaiser method, because programming wise, it's not too tough. But yeah, so we take our PCA reduction, we throw it into a clustering algorithm. Here I chose optics. There are a few reasons for that. One, because you don't necessarily have to do the elbow test. That's just how many ways you're going to be clustering the algorithm. It's your epsilon factor, right? So it's essentially the radius of your clusters, right? Because if you're going to be randomly generating these points and then clustering along the radius of those, it's just going to keep that radius the same. With optics, you can do it over different dimensions, right? So it may find a cluster at epsilon being 0.1. It may find another cluster where epsilon is at 0.5, right? So that's where clustering with optics is great. And also too, it's going to take longer, but at the end of the day, this isn't, if we're looking at this in a real world setting, this isn't going to be the place where we need speed, right? Because you can run this the day, 2 hours before market open, and it'll be done by then, right? And then we look at co-integration. You can set your own confidence level however you want it to be. But like I said, I can't really tell you the secret behind it, but just take what I said before with a grain of salt, and research with your own confidence levels. And then from there, we have a few hard stops. And that is to essentially say, from here, the Hirsch score, right? Now, if we want our spread of the assets or if we want to be able to trade them, right? So for a certain interval, based on, I don't know, a year, 2 years of data, of historical data, we want to say, okay, well, what is our Hirsch score? Now, I put the Hirsch score over to the left, and the reason why it says less than 0.5 is because that just represents a mean reverting process. Now, we want it to be mean reverting just so that we can trade it, right? If we have a spread that is co-integrated, cluster, it fits all the boxes beforehand, but it's trending, well, you're essentially just going to keep getting hit on whatever side of the trade you're going to get smacked on, which you'll see why, right? Because essentially, if we're going long one asset and short one asset, you're just going to be getting hit every single time. Now, then we look at mean reversion speed. So essentially, if we're using daily data, I found best at 9.5. You could push it to 10 to where that's essentially just saying, how long does it take for something to revert on average, or however long your process tends to revert on average. And then you do want it to pass the mean so you can trade it, right? Because if it doesn't pass the mean and it's just very tight to it, then you really can't, you're really not going to be able to trade anything. You're just going to be holding on to cash in your account for the entire time. There you can put it to 30. That's where I found the best results with, however, trying a ton of them. Also, don't set it too high, because then there's not going to be a ton of passes, right? You can't set it too low, because then you're going to get stuff that doesn't revert enough. And then from there, we have our list of pairs traded for a given interval, right? So essentially how I did it in our back test was I took a year of data, and then I got our pairs, and then we traded those pairs for a quarter, right? So from January to February, February to July, so on and so forth. Now you might ask, why did we do it like that? Well, because I think anybody who may be speaking today is, if you're looking at the market, if you're looking at it in a quantitative sense, relationships change. If we're looking at historical data, I know one of the pairs that was selected was HYG and HYLB, and it goes great. It does awesome for one of the given intervals. The next interval gets chosen as well, and it doesn't do great because the co-integrated processes stopped being so volatile. Now what happens there is you're just not making trades, or you're collecting very little, or you're just essentially breaking even on every trade. So with that being said, is since the relationships change, with these hard stops towards the end of the algorithm, we're able to choose or have a best guess on which ones we're going to be able to trade and make money off of. Now, moving on. Now, how are we going to model this spread? So if we have our process x of t, that's our process of the spread. We're just going to take the natural log of asset A and asset B, and then we're just going to have a beta coefficient where it's just the log of the daily returns of A and B. Now, one reason why this does help is because then you can do beta sizing on each position, to where you're also going to be net long or net short on any position by a small amount. So overall, your gross position, or your gross exposure would be 50-50 on $100 essentially. So the trading signals, the S score, as one paper and I called it, so where essentially is we're going to take our modeled spread and we're going to subtract the 1 month rolling mean of that spread, and then divide it by the 1 month rolling standard deviation of that spread. Now, and then down here, you can also read how we're entering and opening trades, as well as the best results found with those two given, I guess you would call them tuples, right? It's where you have the short open, the buy open, the short close, and the buy close. Now, a quick note on the S score, the reason why the 1 month rolling mean was used is because, yes, in a sense, this is kind of a Bollinger Band, but it's not, because if you set a hard stop on any pairs trading strategy or simple strategy, you're going to get out too early, right? Because with the filtration algorithm, we know that it's going to revert. It may just trend a little harder than we thought it would be, but that's the point to where then set up trading amounts would then let you not get margin called, right? So you need to be conservative with how much your exposure is. But with the 1 month rolling mean is, we know it's going to revert, and we'll be able to get out, even if it does start to trend, it's going to revert back a little bit, and we'll be able to have an optimal exit to where we're not going to get hit too hard. All right, and then just with this is just explaining how we enter and close positions. So if you want to look at that for a little bit, essentially all it's saying is, oh, and I should have forgot to put that in, but essentially is when we sell a position, or when we do a sell order, we're shorting asset A of our process here. We're shorting this, and then we're going long here. For a buy order, we're going long A, short B, short order, short A, long B. Right? Nothing too crazy. All right. And then this is just the investment amount. So this is the beta sizing I was talking about. So essentially say how much is in our margin account, right? Because essentially a pairs trading strategy is a self-financing portfolio, because it all takes place in a margin account. So with your margin account, however much you have in excess of what you need, you're going to be earning a credit on that, right? So essentially it's a self-financing portfolio just within a margin account, just does it a different way. So FT would just be our A investment amount. So that's just the way I did it was, if my margin account is at, say, $100, then we do, 100 divided by the beta. And then here, H of T is the investment amount in B. Just take that, multiply it by B, our beta coefficient, and then we have our sizing for our portfolios. Like I said, again, you're always going to be net long or net short by a little bit in every position, but over the long term, it nets out to be a leverage ratio of 1, essentially. That's the way I like to put it, but gross exposure is at 50-50 on 100. Now, backtesting. I want to recall that the test of this, right, because the main idea that I had in that aha moment was really the trading strategy, right? And then trying to pick the pairs where I came up with the filtration algorithm and reading a million research papers. So with the backtesting, I just wanted to test that the filtration algorithm worked, right? I didn't necessarily care what assets, right? So that's what I did. I traded it on an entire universe. I traded it on, simple universes. I tried it on really small universes, and then someone kind of gave me the idea of, well, really, it was a fellow student who was doing a fixed income internship that no one has really done pairs trading in bonds just because the liquidity always dries up. And then I had to do a project for our fixed income class where I essentially said, well, why hasn't anyone done it with fixed income ETFs? Because I understand why pairs trading on bonds or fixed income assets wouldn't work because liquidity dries up, right? So if that's the problem, if we can trade the fixed income ETFs, we should have liquidity. And it turns out that it looks pretty darn good. That being said, the trading strategy that we laid out right in front of us isn't robust enough for, take equities. It's going to be too volatile. The actual price change and movement isn't going to be, the strategy isn't robust enough for that. But it was robust enough to work on fixed income ETFs. So here on the graph to the right, we have the returns. And I benchmarked it against BMOAX. That's just an ETF or an index that looks at the entire bond fixed income market, right? So if we don't necessarily care what we're going to be choosing, but we're just going to be trading fixed income assets, probably a good benchmark to use. And it does pretty darn well, as we can see, or looks to, right? We don't really know if there's a leak in this boat until you put money into it, right? So on here, sorry, I threw a bunch of this at you, but this is really the KPIs. You can look at the return measures and the benchmark, and that's great and all. The great part about this is, again, remember, a pairs trading or statistical arbitrage, they're all supposed to be market neutral. So you should have no correlation whatsoever to broader markets. And as we can see, that seems to be the case, right? Whether you take equities with the SPYs, you take the VIX, take a 10-year treasury, take the LQD spread or HYD spread, it really isn't correlated at all to the broader markets, which is good, right? We know that it's doing its job. Now, if you want to know how I calculated all of this, I could just send you the paper that I have written up for it. But essentially, the Sharp is ridiculous. The Trainer, the Sorrentino all look great. Down to the left, you can see that these are the returns based on just a buy and hold strategy of buying the benchmark that we chose. Again, looking at this, the total operations, again, take it with a grain of salt. In the real world, probably not going to be 94% hit rate, but I think it will do well nonetheless. Again, also too, in the back test is important to note, I took off a round trip of 15 bips on every single operation. So essentially I took off, well, really 30 bits round trip on every single trade. So with that being said, is right, if we do a buy open, or so if we do a buy, right, that essentially has two separate trades, and then if you close that trade, that's another two separate trades, right? So I essentially take off 30 bips at the end of every operation, or put in a cost of 30 bips at the end of every single operation. Now I just want to look at the spread capture. So this is just one of the random pairs that I chose during one of the trading intervals. We can see that the S-score does do a good job of capturing peak to trough. It might be a little early sometimes, might be a little late sometimes, but overall, if it's a good pair that the algorithm chose, it does do a pretty darn good job of capturing the spread. Again, the blue line is just the modeled spread over the given trading interval, and then the top one looks at our buy orders, and then, or sorry, our selling orders, and then the bottom one looks at our buying orders. So essentially, right, when it's low, you want to buy the pair, snag it when it tries and hits its peak, vice versa for a selling order, right? When it's at the top, you want to sell the pair. So it seems to be doing its job. Now, with all of that being said, the main goal of this capstone and what we're going to be doing in the future is essentially the next steps, right? We're going to try and be doing the idea of making that confidence zone over quantile regressions, right? Whether that be an OU process, the LPPLS model, it could be either or. So that's what we're working on now, right? So, and the reason why I want to do that is because The end goal of this is to be able to have a market neutral strategy for all markets. So I want to expand it to be the entire universe of liquid assets. And from there, trade it, have it be automated. And that is where we're at now. So essentially we have the algorithm, we know how we're going to choose the pairs. Now we just need to make make a better trading strategy. And questions?
Charles, I think you lost them all.
I don't think so.
But that's good. I want you to be out there on your own, because I know some people are talking to you without naming names. Let me